Welcome to the video. Today we will explore why rushing unexpected cash into the stock market can be a costly mistake if you have not built a proper financial foundation. We will walk through a proven hierarchy that prioritizes debt payoff, liquidity, and tax-advantaged savings before taxable investing. Here is the agenda for our journey. First, we will introduce the big idea. Next, we will clarify the hierarchy of money. Then we will show why paying off high-interest debt is a guaranteed return. After that, we will cover building a robust emergency fund. Then, we will stack your tax-advantaged moves. Next, we will run an expense audit to counter lifestyle creep. We will end with a practical action plan, a couple of quick quizzes, and the key takeaways. The big idea is simple. True wealth is built by following a strict financial order. If you skip steps, you risk losing money to interest, fees, and poor liquidity. By prioritizing expensive debt elimination and then building a healthy emergency fund, you create a stable base. Only after the foundation is set should you maximize tax-advantaged accounts and consider taxable investing. This approach reduces risk while improving your after-tax, after-risk returns. Let us debunk the idea that investing should always be your first move. If you are carrying high interest balances, especially above 4.5%, and certainly at 8% or higher, you are losing money every month. Investing while holding such debt is like trying to build on sand. Without liquidity, you may be forced to sell investments at a loss or borrow at high interest during emergencies. Therefore, order matters. First, pay down expensive debt. Then, secure liquidity with an emergency fund. Next, maximize tax-advantaged accounts. Only after those steps does taxable investing make sense. This approach prioritizes risk-adjusted, guaranteed wins before taking market risk. Your highest immediate return likely comes from eliminating expensive debt. Any loan above approximately 4.5% and certainly at 8% or higher should be targeted aggressively. Paying off a loan at 8.34% is identical to earning a risk-free, tax-free 8.34% return. While doing this, you should pause non-essential taxable investing. However, do not skip employer matching contributions in a retirement plan because that is effectively part of your compensation. Here is an actionable payoff plan. First, list every debt with the interest rate, balance, and minimum payment. Next, sort by interest rate from highest to lowest and mark anything above 4.5% as a priority. Make minimum payments on all obligations to stay current and avoid fees. Then, direct every extra dollar toward the highest interest debt. Automate these extra payments to occur immediately after payday so you are not tempted to spend the money elsewhere. Finally, see if you can reduce interest through negotiation, refinancing, or balance transfers, provided the total cost decreases and you avoid new fees. While doing this, contribute enough to capture any employer retirement match. This flowchart visualizes the decision process when extra cash arrives. It begins with extra cash and checks whether you have any debt with an interest rate above 4.5%. If so, you apply the avalanche method to the highest rate first. If not, it checks whether your emergency fund is below 6 months of expenses. If it is, you build it to between 6 and 12 months. Once those boxes are checked, you capture the full employer match, then max an IRA, then max your 401k, and finally use a taxable brokerage. A side note reminds you to perform an expense audit regularly. The loop indicates that savings found through the audit feed back into the process. An emergency fund is your financial firewall. The recommended target is 6 to 12 months of living expenses, adjusted for your job stability, income volatility, and family obligations. For instance, freelancers or those in cyclical industries should lean toward 9 to 12 months, while people in more stable roles might target 6 to 9 months. Liquidity prevents panic selling of investments and reduces the need to borrow at high rates during emergencies. It is essentially insurance that keeps your long-term plan intact. This comparison illustrates two approaches. Investing immediately may capture market upside, but high-interest debt continues compounding against you. Additionally, with low liquidity, you might be forced to liquidate investments at a bad time. In contrast, waiting to invest until you have followed the proper sequence eliminates guaranteed losses, establishes a cash buffer to handle surprises, and then positions you to extract maximum benefit from tax-advantaged accounts. This pie chart shows a sample allocation during an aggressive debt payoff period. The largest slice goes to high-interest debt payments at about half of available funds. A meaningful portion builds the emergency fund. A smaller yet important slice ensures you still capture the 401k employer match. Essential expenses are kept lean, and discretionary spending is intentionally small to accelerate progress. Your actual percentages will vary, but the principle is to prioritize guaranteed gains and liquidity. Once you have eliminated high-interest debt and built a robust emergency fund, move to the tax advantage stack. First, capture the full employer match in your retirement plan, because that is free compensation. Next, maximize contributions to an IRA, choosing Roth or traditional, based on your current and expected future tax brackets. Then, maximize remaining space in your 401k for additional tax-deferred growth. Only after these are complete should you add money to taxable brokerage accounts. This table offers practical targets for different scenarios. A person with a stable salaried job and no dependents might hold 6 to 9 months of expenses. The amount increases if you have dependents or work in a higher volatility field, where 9 to 12 months is prudent. The examples show how monthly expenses translate to a target fund size. Adjust these numbers to your circumstances and risk tolerance. An honest expense audit is essential. Identify lifestyle creep such as unused subscriptions, premium services that are not necessary, and luxury liabilities that carry high interest costs. Trim or eliminate these items and redirect the savings toward debt repayment and building your emergency fund. Consider refinancing or replacing expensive vehicles or loans if they impair your progress. Treat every dollar you free up as a permanent raise and automate it toward your goals. Quiz time. You receive $5,000 unexpectedly and have a credit card at 8.34% annual interest. Do you invest in a taxable brokerage expecting about 7% long-term returns? Split the money? Pay down the card first while still capturing any retirement match? Or simply hold the cash? You may pause the video now to think about the answer. We will discuss the answer in the next section. The correct answer is to pay down the 8.34% credit card first while still capturing any employer match. Eliminating that debt yields a risk-free and tax-free return that exceeds the expected market return. This approach improves your financial position immediately and reduces risk. Second quiz. Which person should likely target the largest emergency fund? Consider the variability of income, the number of dependents, and the stability of employment. You may pause the video now to think about the answer. We will discuss the answer in the next section. The correct answer is the freelance contractor with irregular income and 2 dependents. The combination of variable earnings and family responsibilities increases the potential impact of a disruption, so a larger cash buffer is appropriate. This video is for educational purposes only. It is not financial, tax, or legal advice. Your situation is unique, and you should consult a licensed professional who can consider your specific circumstances before making financial decisions. This timeline illustrates the journey from assessment to long-term investing. It starts by listing debts and moves into the avalanche method for high rates. Once debts are controlled, it focuses on building a 6 to 12-month emergency fund. Then it steps through capturing the employer match, maximizing IRAs, and maximizing 401k contributions before moving to taxable investing. Ongoing expense audits run throughout to keep your plan efficient. Here are the key points. Eliminating high-interest debt delivers a guaranteed and tax-free return. Build a 6 to 12-month emergency fund to protect your plans. Always capture the employer match because it is free compensation. After that, follow the sequence of IRA, then maxing the 401k, and finally using a taxable brokerage account. Continue auditing expenses to prevent lifestyle creep and to find more money to deploy. To wrap up the practical steps, list and sort your debts by interest rate and highlight anything above 4.5%. Automate avalanche payments while still capturing any employer match. Build your emergency fund to between 6 and 12 months, typically in a high-yield savings account. After that, prioritize tax-advantaged accounts in the order described, and only then consider taxable investments. Finally, set a recurring weekly expense audit to ensure savings are automatically redirected to your goals. In summary, follow the sequence. Prioritize debt elimination, then build liquidity, and then pursue tax-advantaged growth. Guaranteed returns from paying down expensive debt beat uncertain market gains. Liquidity keeps you from making desperate and costly moves. Use the stack of employer match, IRA, then maxing 401k, before moving to taxable accounts. Continue auditing expenses and automate your progress. If you found this helpful, please like, share, and subscribe, and let us know your thoughts and questions in the comments. Thank you for watching. Please like, share, and subscribe if this helped you, and share your thoughts or questions in the comments. Your feedback helps us plan future videos.